Hello, everyone, and welcome to the weekly update episode for the week from 25th November to 29th November 2019. As usual, I will start with the quote of the week, and the quote for this week is strive for progress and not perfection. On Sunday, I was in a meetup and talking to some of my fellow traders slash investors on option trading, and there were a few people who were really interested in various option trading strategies and have been trying to get into option trading. So while I was discussing with them, one of the person told me that he has been studying option trading for 3 months and is really gung-ho about it, really want to use option trading for generating income and want to create a passive income using options trading. So the question that I asked him, how many trades have you done? And the answer did not surprise me. He said he has not done any trades. So he's been studying option trading for 3 months but has not put in any trades. When I tried to dig deeper, I asked him, why haven't you even tried to put any trades? He said, you know what? I want to make sure that I am doing everything right. I am still learning. I want to get deeper into all the strategies of option trading so that I don't commit a mistake. I don't do a rookie mistake and curse myself later on. So I want to be well prepared before I start to put in first trade. And this answer, like I said, has not surprised me. This is not the first time I have seen people coming to me and very interested in option trading, have been studying about option trading but never placed a trade because they've always been striving to be for the perfect trade. Means they want to know everything about option trading before even doing their first trade. So my suggestion to them was, don't wait so long. Start with a very basic option trading strategy, which is a transition strategy from a stock investing to option trading. And I said, go ahead, do that, learn the system, and the only way you can learn it is actually by doing it. Okay. So again, I think that was a very apt quote for the week, is to not wait until you become perfect, but try to put a goal for yourself that you're gonna learn and maybe do one trade next week. Strive for a continuous progress rather than waiting to be perfect and then get started. Even if you are making some mistakes, at least you are learning and moving ahead. Okay, so that was the quote for this week. Next, I want to talk about how the markets have been doing in the previous week. Most of the time the market was unchanged, at least the broader markets. The SPY, which represents top 500 companies in S&P Standard & Poor Index. SPY opened up at 311.98 and closed at 314.31, only changing 2.33 or 0.75%. Similarly, Dow Jones Industrial Index had changed only less than 0.5%. It opened at 279.68 and closed at 280.95. QQQ had a little more variation than the broader market SPY and Dow Jones Index. QQQ opened on the week at 202.67 and closed at 205.10 with an overall change of 2.43 points or 1.18%. But the most surprising element of all was the IWM, which is an ETF on Russell Index. So IWM ETF opened at 159.03 and closed at 161.77. It was after a long time that IWM had broken the resistance level of 160. Over the past few weeks, while the broader market indexes were making progress and were moving in north direction, IWM had been a bit laggard. So it caught up in the previous week. And that was the biggest change So largely, if I from the trades that we had on board, mostly on a broader indexes and ETFs, it was a little dull period. Also, since we are getting close to December expiration, it was not the right time to put a lot more new trades. It was a good time to close all the trade so that we can avoid a gamma risk in the last few weeks of the expiration period. So that was the quick summary. Before we jump into the trades, I quickly want to talk about the topic of the week. And the topic for this week is covered call. Covered call is a strategy in which you own the stocks and you determine at which price point are you comfortable to let the stock called away or to sell the stock, and you go and sell a call at that price point. This is one of the strategies that I call as a transition option trading strategy for people coming from purely stock investing or trading and moving into option trading. The reason is it is very easy to implement, number one. Number two, the price point and the amount of a premium the user can determine at what price point is comfortable to sell. So they can pick and choose the strike prices at which they are comfortable to sell. Okay. And third, if the strategy doesn't work out, means the stock doesn't get called away, it actually reduces the cost basis of your stock. So a very powerful strategy. I have a lot more in-depth video on this particular strategy on my YouTube channel. I'll post the link in the show notes. To place a covered call, let's say you own 100 shares of XYZ stock and you had owned the share at $50. Now, to sell a covered call, you could look for January expiration, which is 17th January 2020, and maybe sell a covered call at 55. You sell a call at 55, and let's say you collect $2 as a premium, right? So your cost basis is 50 and you are agreeing to sell the stock at 55, and in response to that agreement you have already collected $2 as a premium. So let's consider a scenario that by expiration time the stock has moved higher. Let's say it has moved to 56. Your stock will be called at 55. So the overall profit for you will be $5, which is your cost basis is 50. You are selling a stock at 55. Plus add $2 of a premium that you had received. So your overall profit is $7. Let's say the stock does not move beyond 55 and at an expiration the stock is at 53. In that case, you will retain the whole $2 premium that you have received when you open the trade, and because you have retained the premium, you have reduced the cost basis of the owning those stocks. So now the new cost basis is $50, subtract $2 of a premium, so the new cost basis is $48 only. So hence, covered call is a very powerful strategy to generate a stream of income. So you have done this for January expiration. Stock did not get called away because stock was at 53. It was not at 55. Then you can again rinse and repeat same. You could again go ahead and sell a covered call for, let's say, $56 or $57, collect some premium. If stock gets called away, great, because you're comfortable in selling the stock at that price, and if it gets called away, no worries, that's what you wanted anyway. But if the stock doesn't get called away, at least you have reduced the cost basis of your stocks by the amount of premium that you have received. Alright, that's all for the topic of the week. Like I said, I do have a video on my YouTube channel, Optiongig. Go to YouTube and in the search bar put Optiongig. You should be able to reach to the channel, and there is a video on it on the covered call, and there are a lot more videos explaining the basics of option trading. You can also go to my website www.optiongig.com and get into the education area of the website. You will see a lot of videos categorized for beginner, intermediate, and advanced level of option traders. Again, those videos point to the ones which are on YouTube. So if you subscribe to the YouTube channel, you will get notified as and when I post new videos over there. Next, we're gonna talk about are the trades. So first, let's look at the trade summary. In the past week, like I said, we were mostly focused on closing the trades, and market wasn't moving really much. The volatility, the VIX was really low. It was like around 12 and less than 12. So it didn't make much sense to open new trades. So I was focused mostly on closing my current positions. So totally we closed 20 trades. Out of 20 trades that I closed, 17 were profitable and 3 of them were losers. So almost 85% of the trades were winners. I'll take that anytime. And we opened just 7 new trades. Okay. Looking at the numbers, the gross profit on the trades that we had closed was around $2,600, and the gross loss on those 3 trades that we lost money was $710. So the gross income or the net profit was almost $1,900 for the week. I will consider that it was a good week. I'll be very frank, every week is not like this, that you can generate close to $2,000 of net income doing option trading. Probably it was a lucky week for me or whatever, but I think I'm pretty much happy with it. Doing option trading part-time and able to generate some income, it's good. So it was a great week. The last week was a good one from a trading perspective. I also opened 7 new trades, and the new premium that we sold was almost $1,700, $1,681 to be precise. And most of the trades that we opened would be for January expiration, or if there were some adjustment trades for the December, that would be included. I am not planning to open any new trade for December expiry because we are in last 3 weeks of expiration for December, and the gamma risk is really high. So based on my trading strategy, I do not want to open any new trades. Of course, if there are some trades to be adjusted and that demands me to open a new adjusting trade, yeah, we would do it, but not necessarily net new trades in this point of a time. Okay. What I also want to do is to give you a brief glimpse into, let's say, top trades. Obviously, I cannot go through all the 20 trades that I have closed or all the 7 trades that I have opened, but what I've decided is maybe give you an insight into what are the top leaderboards, top profitable, top losers, and maybe the top premium trades for the last week. I do post all my trades on my website optiongig.com. Go to the trades menu and you should be able to see the trades posted there on day by day basis. Once I do a trade within 5 days, those trades will be posted on the website. If you want to really follow all the trades that I have done, you could actually go to my website and look at the trades on day by day basis. All right, so let's look at the leaderboards here. Top trades of the week, top 3 closing trades which were profitable. The most profitable trade was Square, and it has got a brief history, and I'll explain it. And it's a good case study of how you can use options to actually adjust the losing trades without adding additional capital. I think with stocks that's not possible, but with an options it is. So a brief history on Square. I had initially opened a Square trade in July, and when the Square was, I think it was above 75, and I was okay to hold or to buy the Square share at 70. So I had opened a 70 short put in July. Wrong timing. Like I say, you cannot predict what the stock will do in a short term, irrespective of whatever the analyst may be saying or how much ever bullish you may be. Stock will do what it wants to do. So after I put on a trade for a short put for 70, stock moved only in one direction, which is south. And I kept rolling the trade from July expiration to August, from August to September, September to November, and finally from November to December. And so I've been defending this trade for a few months, and now recently Square came back up and I was able to close this trade profitably at a profit of $673. I also made some adjustment trades. For example, I opened up a short call so that I can reduce the risk on the short put side. And so we used all those adjustment techniques, but eventually I was able to exit this trade for a profit, even though the stock hasn't cooperated when I initially put in the trade. So that's the beauty of option trade, is you can use a lot of adjustment techniques without adding any more capital. Okay, that was a top performing trade for me. The next one I want to look at is Shopify, with the ticker SHOP. We closed out our short put on Shopify. We had sold the short put on 1st of November, and on 26th of November, I have closed this trade at almost 80% of max profit. When I initially sold the short put, I collected $5 as a premium, and it was a December expiry $270 short put. And at that point of a time, I was okay to buy Shopify at $270 because I think that's a really, really good price to buy Shopify. I would not mind owning Shopify at $270 per share. So I opened up a short put trade for it. The trade worked in our favor. Shopify continued to stay above 270, and on 26th, which is within 25 days, I was able to close the trade by buying back the short put for $1. So net we made $400 in this particular trade. The third top grossing trade is Zoom. Again, Zoom also, it was a short put trade. I had opened up a bullish position in Zoom on 31st of October, and it was a plain simple short put. I was bullish on Zoom, so I wanted to acquire Zoom. Zoom at that point of a time was trading at around $70. So I gave myself some room for error in case stock does not cooperate and move in south. So stock was trading at 70. So I went ahead and sold a short put at 65, giving myself $5 of a margin of error, and also collected $4.35 as a premium. It was a very rich premium trade because on a short put of 65 means if I were to own, I'll own it at 65, and upfront I had already collected $4.35, which is 8% premium of the stock. Which is good. Not every stock is so rich in premium, but Zoom was. Stock was just moving within a range. It went up, sometimes it came down, but mostly it was within a range. So the premium got sucked out, and on 27th of November, I closed this trade. Multiple reasons. Number one, it already met my profit target of 50% of max profit. Number two, there was a earnings coming up in by the next week. So whenever there is an earnings expected, the volatility will increase, which goes against us. So why take the risk when our trade is already making profit? And so I would rather close it, make sure I bank the profit, and use it for Thanksgiving gifts. The third reason was, again, if there were no earnings, I would have still closed the trade because it was getting almost 22 days to expiration. It's getting closer to December expiry, and as and when you get closer to the expiration period, the gamma risk on the trade becomes higher and higher, and I don't see any good reason to stay in a trade if the trade is profitable right now. So I closed the trade, took the profit, and I think it worked out pretty well for me. So these were the top trades, profitable trades, and of course every trader has some profitable trades and loser trades, and so I'm no exception. So here are the top 3 losing trades. One was on Baba strangle. So I had a Baba strangle on Alibaba. The ticker symbol is BABA. The strangle was 150 short put and 195 short call, because I own Baba in my long portfolio, and it would have been okay if the stock would have gotten called at 195. So that was a strangle. We had opened on 21st of October. Baba had moved up because of the discussions between US and China government on a trade war truce. Maybe we'll reach an agreement, and on that hope Baba had moved up, and we made some adjustment trades by moving up our short put from 150 to 175, and on 27th I rolled out the whole 195 short call to January expiration period and collected additional premium. So in this particular individual trade, so when I bought back 195 short call, I had to pay money which was more than what I had, the initial premium I had gathered. But since I also sold the January 195 call, if you stitch together all the 3 trades, net I have sold off 195 call, and I have collected a premium of almost $7. So we'll see it in the next section of our discussion. But whenever you roll a trade from one expiration period to another, you are buying back the current month or the current expiration trade and opening a future dated expiration trade. And when you're buying back, you might incur loss on that trade, but you sell a more premium for the future dated trade, and you may be able to recover all that and more when the next trade expires. Okay. The second trade was a Square. I had a Square 70 call, and which we had opened at 72 cents, but we had to close it back. We closed the overall trade at profit, even though we lost on the 70 call side, but we made more than enough money on the 70 put side, like we had reviewed earlier. The third losing trade I want to talk about was a short put on IQ, which is a symbol for IGE. It's a Chinese company called as Netflix of China. So we had sold a short put at a strike price of $17.50 on 7th of November, and on 29th I closed this trade. Overall on this particular trade we lost $8, but this trade, along with this trade, I also had a 20 short call, and I made more than enough money on the 20 short call trade to compensate for the loss of $8. Again, similar case as what we had reviewed on the Square, wherein we lost money on call side but made more than enough on put side. In case of IG, or ticker symbol IQ, we lost $8 on the put side but made more than enough on the call side to close the overall trade for profit. Next, I want to review the new trades that we opened. The first trade that we're going to discuss is the rolling out of the call on Alibaba, ticker symbol BABA. We talked about it in our previous section, wherein I had closed the 195 call, and that showed up as a losing trade. But like I had mentioned, when you close the call and roll it to the next expiration, you collect a lot more premium for the next expiration. So this is the opening of a next expiration, which is January expiration trade for 195 short call. Just in this particular individual trade, we collected $11.34 for just the rollout. The second trade I want to discuss is a new opening trade for DocuSign, ticker symbol DOCU. I've been bullish on this company for quite long. So very vanilla, plain, short put opening, a bullish position opening on this particular ticker. Overall, we collected $3.70. And again, if you really look at it, it's a $70 strike price, getting $3.70 as a premium, which is, I think, is a decent enough premium. The last trade I want to talk about is a covered call trade for the company Yushin, ticker symbol UXIN. I hold this stock in my long portfolio and I'm long-term bullish on it, but also I want to continuously reduce my cost basis, so would like to sell a covered call on it. Initially we had bought the shares at $2.54 and then I had sold some covered call and reduced my cost basis to $2.40, which is almost 5% reduction in cost basis. The stock hasn't done much, but because of use of covered call, I was able to reduce my cost basis by 5%. And I would like to do that continuously, and hence selling another covered call, this time for January expiration, for a strike price of $2.50 and collected 30 cents as a premium. So this covers all our trades, and this brings us to the end of this podcast. As always, if you have any questions, please write it to me at optiongig@gmail.com. If you have questions about these trades, do comment it on YouTube video. I'm going to post this also on YouTube, or comment it on the podcast. Or if you have any questions on some of your trades, please write it to me. I'll be very happy to answer your questions, and it is always exciting to get questions from viewers, from listeners, and engage in conversations with them. I hope you like this one, and if you want to continuously follow my trades or my videos, do not forget to subscribe my YouTube channel. Go to youtube.com, search for Optiongig, and click on the subscribe button. Thank you very much. Have a wonderful day and happy trading. Please note that all the information presented in this podcast is purely for educational purposes and is not a financial or investment advice. I don't know you, you don't know me, so do yourself a favor and don't invest or trade solely based on what you hear.